Your mortgage is about to cost you $500 more every single month, and the rate cut you're waiting for is not coming. Welcome to Maple Money Talks. 1.15 million Canadian households are renewing their mortgage in 2026. That number comes directly from the Canada Mortgage and Housing Corporation. It is not a projection from a real estate agent trying to sell you something. It is not a prediction from a bank with a product to pitch. It is the Federal Housing Agency's own headcount of the people whose contracts are expiring this year, and most of them locked in during the pandemic. In February 2021, the lowest 5-year fixed mortgage rate in Canada sat at 1.39%. Variable rates were even lower. People were buying homes, renewing contracts, and locking into rates that looked like a rounding error. At the time, it felt like smart planning. Today, those same contracts are coming due. The rate those households are renewing into is not 1.39%. The Bank of Canada's policy rate today sits at 2.25%. The prime rate sits at 4.45%. A 5-year fixed mortgage in the current market is priced somewhere between 4.4 and 4.8%, depending on your lender and your profile. That gap between where you were and where you're landing is the entire story. Let us make it concrete. Take a household with a $500,000 mortgage and 20 years remaining on their amortization. At a pandemic-era rate of 2.5%, their monthly payment was roughly $2,650. If they renew today at 4.5%, that payment becomes approximately $3,150. That is $500 more every month, $6,000 more every year, not because they borrowed more, not because their home got more expensive, simply because the contract expired and the rate reset. The Bank of Canada's own research found that about 60% of outstanding mortgage holders renewing in 2025 and 2026 are expected to see a payment increase. When you break down who is inside the 60%, the picture becomes specific. Approximately 75% of those facing a payment increase hold a 5-year fixed-rate mortgage. The ones who locked in for the longest terms at the lowest rates are now facing the sharpest adjustment. And the average increase for those borrowers is not 2 or 3% higher monthly costs. The Bank of Canada's analysis puts the average payment increase for 5-year fixed holders renewing now at 15 to 20% above what they were paying in late 2024. That is not a rounding error on a household budget. That is a structural change to how much money is left at the end of every month. Now here is where the story gets more complicated than most people expect. The natural assumption is that the Bank of Canada will keep cutting rates, that lower rates will arrive in time to ease the pressure, that if you just hold on, the situation resolves itself. This assumption is understandable. The Bank of Canada cut 9 times between mid-2024 and early 2025. 9 consecutive reductions that brought the policy rate from above 5% down to 2.25. But that cycle has stopped. On January 28, 2026, the Bank of Canada held its policy rate at 2.25%. The bank's statement described the current rate as, quote, about right to support economic conditions. That language matters. It is not the language of a central bank preparing to cut again. It is the language of a central bank that believes it has done what it set out to do. The Bank of Canada's own fourth quarter market participant survey, which polls representatives from banking, research, and asset management firms, showed that all respondents expected a rate hold throughout 2026. All respondents, not a majority, not a consensus, all. And here's the detail that almost no one in the mainstream housing conversation is discussing. Scotiabank and National Bank of Canada are not forecasting a rate hold. They are forecasting a rate increase, 50 basis points, a hike to 2.75% by the end of 2026. Not a cut, not stability, a hike. This divergence between institutions matters because it reflects a genuine underlying tension in the Canadian economy right now. Inflation came in at 2.4% in December 2025. The bank's target is 2%. That gap is not dramatic on its own. But core inflation, the measure that strips out volatile items, has remained sticky. It is not falling the way the headline number suggests. And then there is the import problem. When Canada placed retaliatory tariffs on American goods throughout 2025, the cost of imported products inside Canada went up. Food prices climbed. Input costs for Canadian manufacturers rose. The Bank of Canada noted in its own February 2026 research that prices for some imported goods increased exceptionally quickly. Coffee prices in December 2025 were 31% higher than the same month in 2024. Beef retail prices were 17% higher year over year. These are not numbers that make a central bank comfortable cutting rates. The trade conflict created a specific bind. Tariffs function like a tax on consumption. They raise prices. Rising prices look like inflation. The Bank of Canada's job is to keep inflation at 2%. If imported inflation from the trade war is pushing prices up, the bank has less room to cut, not more. This is the trap. The mortgage renewal pain is real, but the tool most people are counting on to fix it, another rate cut, is not available the way they think it is. The bank cannot cut into inflation. If tariff pressures persist, or if the trade conflict escalates again, the bank may be forced to hold longer than anyone currently expects. Or, per Scotiabank and National Bank's forecasts, to raise. If you are renewing this year and you are waiting for a rate cut to save you, you may be waiting for something that is not coming. Now let us talk about the actual decision you face. Fixed or variable? This is the question every renewing household is wrestling with right now, and the math on it in early 2026 is genuinely unusual. For the first time in 3 years, variable rates are priced better than 5-year fixed rates. The gap is approximately 85 to 95 basis points. The best 5-year variable rates are sitting below 4%. The best 5-year fixed rates are above 4.5%. On a $500,000 mortgage, that spread represents real money over a 5-year term. But that spread exists because variable rates follow the Bank of Canada's policy rate, and markets believe that rate will stay flat or possibly rise. Variable rate savings are only realized if the bank holds or cuts. If Scotiabank and National Bank are right about a rate hike, those variable savings shrink or disappear. There is a second factor that most people overlook entirely. 5-year fixed mortgage rates are not priced off the Bank of Canada's policy rate. They are priced off the 5-year Canadian government bond yield. And that yield has been moving. In late 2025, the 5-year bond yield jumped from 2.7% to just above 3% in less than 2 weeks. A 35 to 40 basis point spike that lenders responded to immediately by raising their fixed rate offers. Bond yields are under upward pressure from several directions. Trade uncertainty is reducing foreign demand for Canadian bonds. If the United States economy strengthens faster than expected, American yields rise, pulling Canadian yields with them. If Canadian inflation stays above target, bond markets will price in future rate hikes, pushing yields higher still. The 5-year bond yield currently sits in the 2.8% range. Major bank forecasters project it reaching 3.19% by the end of 2026. If that happens, 5-year fixed mortgage rates in Canada move up, not down. This creates an unusual scenario. Variable rates stay relatively stable if the bank holds. Fixed rates move higher as bond yields rise. The window to lock in a 5-year fixed rate at current levels may be narrower than most renewing households realize. This is not a recommendation. It is a description of the forces at work. The right answer for any individual household depends on their income stability, their remaining amortization, their tolerance for payment variability, and their specific financial picture. But understanding that fixed rates are driven by bond markets, not the Bank of Canada, changes the entire framework of the decision. Now let us talk about where you live. The mortgage renewal story is not uniform across Canada. 2 provinces are experiencing what the data describes as significantly elevated financial stress among renewing borrowers: Ontario and British Columbia. In the Greater Toronto Area specifically, mortgage arrears, defined as payments missed by 90 days or more, quadrupled over the past year. That is not a slight increase, that is a 4-fold increase in households who have fallen behind. This reflects the combination of high average mortgage balances in these markets, a housing correction that reduced equity cushions, and the payment shock of renewing from pandemic rates. Average home prices in the Greater Toronto Area fell approximately 6% in 2025. Average prices in some northern GTA municipalities, including Brampton, Vaughan, Markham, and Richmond Hill, fell more than 10%. A household that bought near the peak in 2021 or 2022, locked into a low rate and is now renewing, faces a layered problem. Their payment is going up, their equity may be reduced, and the market they are in is not recovering quickly. British Columbia presents a similar picture. Vancouver's mortgage payment to income ratio, even after 8 consecutive quarters of improvement, still sits at 85% of household income. The improvement has been meaningful, down from a peak of 103.9% in 2023. But at 85%, the buffer for any upward movement in payments is thin. Alberta tells a different story. Calgary's mortgage payment to income ratio sits at 40.9%. The long-run average for Calgary is 39.2%. The province's economy has benefited from elevated energy prices and a labor market that has absorbed more workers than most regions. Renewing borrowers in Calgary are not facing the same cliff that renewing borrowers in Toronto are. This regional divergence matters because it shapes what options are available at renewal. Borrowers in markets with strong price appreciation and manageable debt ratios have more room to extend their amortization, access home equity, or negotiate from a position of strength. Borrowers in markets with declining prices and stretched ratios have fewer of these options. The CMHC noted that people are saving less, reducing discretionary spending, and taking on other forms of debt to manage the cost of home ownership. That is a description of households consuming their financial buffer. It does not mean defaults are about to spike nationally. TD Economics argued the renewal wave will not shock the financial system as a whole. But it does mean that for individual households in specific markets, the renewal is not a paperwork event. It is a restructuring of their entire household budget. Now let us talk about what you can actually do. If you are renewing in 2026, the most consistent advice from every independent mortgage professional is the same. Do not wait until your maturity date. Most lenders allow rate holds up to 120 days before renewal. That window exists to protect you. Using it means you can lock in today's pricing. And if rates fall between now and your renewal date, most lenders will match the lower rate. If rates rise, you are protected. The second piece is that you do not have to renew with your current lender. Switching lenders at renewal typically costs you nothing, no penalty. And Equifax data shows that 28% of renewing homeowners switched lenders in 2025, up 46% from the year before. More people are realizing that the bank's renewal offer is a starting point, not a final number. The third consideration is amortization. If the payment at your new rate is genuinely unmanageable, extending the amortization reduces the monthly number. A borrower who extends from 20 years to 25 years at renewal will pay more total interest over the life of the mortgage, but they will reduce their monthly payment now. In a tight household budget, that trade-off may be worth making. Half of the borrowers facing payment increases in 2026 could eliminate those increases entirely by extending amortization by 5 years. This brings us to the final reality of the 2026 mortgage market. 1.15 million households are renewing this year. Another 940,000 are renewing in 2027. These are not small numbers. They represent a rolling wave of financial adjustment that will work its way through household budgets, consumer spending, and housing demand across the country for the next 2 years. The Bank of Canada is holding. Bond yields are rising. The trade war created inflation the bank cannot simply cut away. And the households who benefited most from the lowest rates in Canadian history are now facing the largest payment resets in a generation. The system is not breaking, but it is adjusting. And the cost of that adjustment is landing on individual households, month by month, renewal by renewal. If your mortgage is coming due this year, you now know what you are walking into. The question is how much runway you have to prepare for it. This content is for informational purposes only and does not constitute personalized financial or mortgage advice. Consult a qualified mortgage professional or financial advisor regarding your specific situation before making any decisions.